Okay, all right. Abhilash Narayan is now joining us, Senior Investment Strategist, Group Wealth Management at Standard Chartered Bank, Singapore. Abhilash, great to have you with us here. Thank you very much. Uh, obviously last night you did not party, Abhilash. I hope, I don't know what your
Clearly
plans.
not.
Or maybe you did. We'll find out.
Don't feel too bad, Abhilash. We're all with you. All of us are here bright and early this morning. Whether the viewers are there or not, we don't know.
If the replies come a little slow and you slur your speech a little bit, I mean, we'll know. We'll understand. Abhilash, how are things looking as we wrap this year up? It's the last data point, I guess, but it's, weekly the claims number. Would you put a lot of weight to it? Because we have the numbers which came slightly below expectations, the rally last night, the drop in yields is being attributed to that. But weekly data can be pretty volatile, isn't it? Your sense?
Absolutely. And I mean, I wouldn't put too much weight into it because of one, it's a weekly data. And secondly, at this time of the year, the liquidity in the markets is fairly muted. So, the moves can be a bit exaggerated. Now, clearly, if you think about US jobs market data, any bad news is being treated as good news by the markets because at the margin, what that means is that it reduces the probability of Fed continuing to tighten the monetary policy at an accelerated pace. So a weakness in labor markets is viewed positively. I think just one thing that stood out to me from yesterday's data release is not only did weekly claims increase, but if you look at the continuing claims, which means that people who have applied for jobless benefits previously and are still claiming them, that rose to 1.7 million, which is the highest number that we have seen since February of this year. And that just goes to show that, for people who are out of the job market, getting into the job market, finding new jobs is not as easy as, what it seemed a few months back.
Okay. Abhilash, good morning once again. We just had a comment coming in a while back about how the outperformance in China over markets like India is something that could lead a lot of flows into China in 2023. Would you reckon that could be the case? I mean, will money move out of India and into China, or will there be outsized flows across the board?
Morning, Sonia. Well, clearly, I mean, the policy shift that we have seen in China over the past month has been much faster than what most of us were expecting. The pace of reopening was just unexpected, and that clearly has acted as a catalyst for Chinese equities. But we've seen Chinese equities rally around 20% or more than 20% since the October lows. So we think in the next 1 to 3 months there could be a bit of consolidation. So in the near term, the risk of outflows is sort of muted. But if I think about the whole of 2023, we think that, yes, there is a risk of reallocation of flows, more towards China for the year. But overall, we think that emerging markets should get net inflows from US and European investors. And that's simply because we expect, we are assigning a 75% probability of recession in US and Europe next year. And Asia is clearly a bright spot. I mean, India is expected to grow close to 7%. For China, we have a 4.5% growth forecast. So in an environment where there is recession concern in US, Asia and India, India and China are likely to attract capital flows. So net, we think that FDI flows should be positive for Indian equities.
Right. While flows would be positive and everyone's looking at India to outperform in the next year as well, after a great outperformance that we saw in 2022, Abhilash, at what point do valuations start to become a concern for India?
Well, we think that valuations are kind of stretched. So recently we downgraded Indian equities from overweight to neutral within the Asian context. And, while if you think about the underlying economic growth, that remains fairly robust. If you look at earnings expectations, we expect 15% earnings growth for FY23 and close to 18% earnings growth for FY24. So earnings growth are quite solid as well. But on a relative basis, Indian equities are quite expensive. And, heading into 2023, we have turned underweight on equities globally. So we think that any market which is trading at elevated valuations could come come under some pressure. So net, we still think that Indian equities should outperform global equities, so US and European equities, but the absolute returns may be muted going forward, and that's why we have turned neutral on Indian bonds versus Indian equities.
Okay, neutral on Indian bonds versus Indian equities. That's interesting. So if you're saying that, there is, of course, strong earnings growth and, the pace of reopening in China has been pretty good. Policy shift in China has been faster. Do you think that for the rest of the year, does it top your market A, your market list, that is preference list? And B, what is the strategy now from an Indian investor standpoint?
Well, so we are overweight in Asia-Japan bonds, Asia-Japan equities, and within that we are neutral on India. So implicitly, we are somewhat positive on Indian equities compared to the global context. But within Indian markets, we do have a preference for large cap equities, and from a sectoral perspective, we like financials as well as industrial sector, because we think that those are the sectors where we could see, a really solid earnings growth come through.
All right, we'll leave it there, Abhilash. Appreciate you joining in, and Happy New Year from all of us here. Thanks very much.
Wish you and everyone a Happy New Year as well. Bye-bye.
Thanks indeed. Well, we'll take our first quick commercial break here. So that's a global view coming through. But on the other side, our top stocks to watch with our research team, as always, coming up in just a bit.